Hey, what's up everybody? It's Cameron from themoneyventure.com. Today we're going to go over 10 indicators of successful stock investments. But first, you're probably wondering, why should you trust me? Well, here's a little bit about my background. I've been investing for just about a decade. I'm a former registered investment advisor. I've passed multiple investment broker licensing exams. I've achieved successful returns on my own retirement and individual investment accounts. And I've also worked with a lot of the largest banks, along with their affluent clients, in helping them manage their investments. So let's get started. Here's a quick summary of the 10 things to look for in a company when determining whether to invest in them or not. First off, does the company have an industry moat? Does the company's product or service have a strong network effect? Does the company have a sticky product or service? Does the company have strong financials? Does the company have a strong executive team? Does the company have a large market opportunity in front of them? Do you believe in that product, service that the company offers? Is the company, product, or service boring but essential, which is actually a Peter Lynch strategy if you're familiar with Peter Lynch? Does the company have a strong culture among its employees? And finally, does the company operate in a growing industry? These are just 10 indicators to help you determine whether a company is worth your money or not. The more indicators that a company covers, the more of these indicators that a company has, the better the opportunity. Now, chances are most companies won't have all 10 indicators, but you get the idea. The more indicators that they have, the better. Before diving in, let me add a quick note to those skeptics out there that think picking winning stocks is the same as gambling, because it's actually completely different. Here's why. Gambling is deciding without any concrete or fundamental facts behind your decision. You're flipping a coin and hoping that you'll make some money. But picking stocks, on the other hand, comes down to using facts to back up the reason that you're putting your money into a company. It helps you pick winning investment by using factual data that the company publicly announces, and ultimately allows us to make an educated decision on whether they're a good investment for our portfolio or not. To start, what is an industry moat? An industry moat means the company has a clear competitive advantage over the market competition. This could be anything from patents to pricing advantages, meaning they can get products or services at a much lower cost. Size advantage, meaning a company's size is so much bigger, they can dominate the industry. If there's high market entry costs, meaning it's difficult for a company to start their product or service in that industry due to the high cost of entering that industry. And lastly, technology advantages. Some companies have just built a technology infrastructure that's so complex that it's difficult for anyone else to come in and compete with that. The next thing to look for in a company is whether the company has a product or service that has a strong network effect. A network effect simply means that the more people that use this product or service, the more valuable that product or service becomes. A few examples of this are Facebook, Twitter, PayPal, and Apple. Each of these companies have a product that grows in value the more people that use it. None of us would be on Facebook or would have a Facebook account if we didn't know that everyone else in the world also has a Facebook account. None of us would use PayPal if all of our friends and family didn't have a PayPal account as well. And this makes it easy for us just to simply transfer money because we know that most people have PayPal. The same with Apple. They have the Apple iPhone, for example. Many people want the FaceTime option on Apple iPhone, and it only works with other people that have an iPhone, and so you have to get an iPhone in order to use FaceTime. These are all examples of a strong network effect of a product. Next up, does the company have a sticky product or service? A sticky product or service simply means it's difficult to get rid of that product or service because it's so valuable. This is a little bit different than a network effect, whereas a network effect means the more people that use the product, the more valuable the product becomes. A network effect in and of itself can be an example or an attribute of a sticky product as well, but they're slightly different. A sticky product, again, is one that is difficult to get rid of. A few examples of this, of companies that have this, are Amazon, Apple, and Microsoft. Each of these companies provide products or services that are basically would make it difficult to live without. Apple, they've got a very strong brand and platform operating system for computers, tablets, and phones that most people just couldn't live without. Microsoft provides an operating system for the majority of business computers around the world. And Amazon is a platform that basically lets people purchase anything online and get it within 2 days. These are all things that would be difficult to get rid of and would be hard for us to imagine a life without. A more obvious sign to look for in a good company is whether they have strong financials. Indicators of a strong financial background of a company are the following. Do they have high amounts of cash? Low debt? Do they have levered free cash flow? Which levered free cash flow basically means, do they have cash left over after all of the bills are paid? Do they have a growing revenue or growing sales? Do they have growing earnings per share? Do they have a high return on equity? Are their margins high relative to the industry average? These are all great examples of a strong financial background of a company. You can find these on Yahoo Finance, and you just click on the financials of the company, and you can break it down either by year or by quarter and review whether the company that you're looking to invest in has any or even all of these good signs of positive, strong financials. Next up is, does the company have a strong executive team? This simply means, is the executive team ones that have an innovative mindset, that are able to see company visions for the future that go along with market trends. It's not just a strong knowledge executive team. It means visionary, innovative type executive team, along with the strong management skills, financial skills, etc. Here's a few good and bad examples of strong executive teams. Good examples, of course, are Apple and Amazon. We all know Apple and we all know Amazon. Amazon, Jeff Bezos, wouldn't be the same company that it is today without the vision of Jeff Bezos, and Apple wouldn't have gotten to where it is without Steve Jobs. As you know, he was actually fired from his own company, and the company went downhill, and they hired Steve Jobs back on, and look at the company. It's grown drastically since then. Bad examples of this are WeWork and Under Armour. WeWork isn't a publicly traded company, although it was about to be publicly traded. But the CEO of the company basically had very unrealistic expectations, which is a negative sign as well. Under Armour seems to have different executives all over the team, and although they have a good product, one that I personally enjoy and I hope to see the company turn around, their executive team hasn't been able to show that they can grow their company and bring it back to life. And one place that you can actually go to for additional information to determine whether the company executive team is strong or not is job boards like Glassdoor, for example. You can go and see how the employees rate the CEO. You can do a basic Google search to figure out whether the CEO of that company is liked or disliked by the public and the people in general. And these are good indicators of whether the CEO or the founders and the executive team have a good vision and a strong background to continue the growth of that company. Another positive sign of a potentially good investment is whether the company has a large market opportunity. This simply means that their product or service can apply to a very large market and could potentially reach a lot of people and thus be a very successful company. Smaller companies have a lot of room to grow but come with more risk. Examples of these are Roku, Zillow, Dropbox. Each of these companies are very innovative in the area, in the space that they're in, and could potentially impact the world for the better, but with that comes risk as well. But they do have a large market opportunity. Large companies, on the other hand, like Amazon, for example, can have large market opportunities in the sense of them branching out into other markets and other industries. If these are things that you see in a company that they're branching out to new industries, or they're in an industry that has a lot of growth potential, these are examples of large market opportunities and thus potential large gains for that company. Next up is whether you believe in that company's product or service in general. Chances are, if you don't believe in that company, there's a lot of people that think the same as you do, and vice versa as well. If you truly believe in that company and they have a strong product or service that you absolutely love, chances are that there's a very large crowd that thinks the same and feels the same as you do. Your investments are more successful, more satisfying when you believe in what you are investing in. But if it's something that you have no idea about, that you don't necessarily believe in, you just think or heard from some guru that it's a good investment and you decided to do so, it's just not as much emotion or sentimental value in your investment portfolio when you don't believe in that company. This next example is one that I actually learned from Peter Lynch's book, One Up on Wall Street. He suggests finding companies that are boring but essential in what they do. And it's kind of interesting because those boring companies, they may have a very vital role in what it is that they do for our economy, but little people talk about them, but they make for great investments. Perhaps the best example of this, in my opinion, would be waste. If you know what waste management is, it's pretty much the market leader in garbage disposal. And so it's something that is always going to be there. It's something that's very important for our economy to maintain its health. And so chances of that company going away are slim to none. But it's also about as boring as you can get. If you can find companies that have these types of aspects, they're also a good sign of a potentially stock investment to add to your portfolio. Next up is whether the company has a strong culture among its employees. The employees can be considered the goose that produces that golden egg, and if you don't take care of that goose, it's not going to continue producing that golden egg for very long. Another way to figure this out is just do a basic Google search on the culture of a particular company. Again, searching on job boards and a lot of job boards, again, such as Glassdoor, will show you what the employees feel about that company and the culture of that company. If the ratings are positive, then that's a good sign that you might have a company that has a strong culture and will continue producing good products and service. And last but not least is whether the company operates in a growing industry. Now this differs from a large market opportunity, which we mentioned a minute ago, in that a large market opportunity means that the opportunity is already there and there's already a large market and a large need for that product or service. But a growing industry, on the other hand, is a company who provides a product or service that's almost in blue water, that's never been touched before. And it's growing, it has upward trends, but that means that it's in a growing area and thus can ultimately be a potential large market opportunity in the future. Examples of this might be remote work, as we're all facing the global pandemic. Zoom and Slack, both of those are great companies that have a large opportunity in front of them from all of us being forced to work at home at this time. Another opportunity is data-driven technology. We're finding that companies that use technology to their advantage to ultimately determine what it is that their customers want and need and can pinpoint exactly the product for them is a huge opportunity and something that's a growing industry and can potentially be a large market opportunity in the future. So there you have it. Those are 10 different things to look for when searching for good companies to invest in. Here's a final summary again. Does the company have an industry moat? Does the company's product or service have a strong network effect? Does the company have a sticky product or service? Does the company have strong financials? Does the company have a strong executive team? Does the company have a large market opportunity? Do you believe in that company, product, or service? Is the company's product or service boring but essential? Again, coming from Peter Lynch. Does the company have a strong culture among its employees? And lastly, does the company operate in a growing industry? If you look for companies that have these characteristics, you can do a little bit more discovery to determine whether they fit your investment style and fit your objective for your investment portfolio. Thanks for watching. This is Cameron with themoneyventure.com. If you found this video helpful, please give us a thumbs up located just below the video. Don't forget to subscribe to our YouTube channel by clicking the subscribe button below to be the first ones notified about our latest content.